Welcome to Barchart's series of educational webinars designed to inform you of a variety of investment ideas and trading concepts. Today's subject, head and shoulders, a powerful and reliable trend reversal pattern. Now, chart patterns can help traders predict possible outcomes, identify trends, and provide greater confidence in their trading strategy. But while there are many patterns exist, only the few stand out as powerful and reliable as the head and shoulders pattern. The popularity and the ease of recognition of the head and shoulder lies in several factors. Its visual representation of a shift in market sentiment as price transitions from one trend to another, and their symmetry in the price pattern, time, and volume that tends to even the least experienced traders' identification. Hello, everyone. My name is John Rowland, Barchart's head of trading education, and although the head and shoulders pattern is the most recognizable pattern, traders and investors still make mistakes surrounding its formation, like jumping the gun without proper confirmation or underestimating the role of volume and neglecting the minimum price objective. So stick around as I offer some simple and concise rules to identifying head and shoulders and show you some predictive powers to enhance any investor's portfolio of knowledge. Now, to help me with today's session is Barchart's project director and our moderator, Gene Baker. Hello, Gene.
Good afternoon, John. How are you?
I'm doing well. I understand you're a little under the weather, so I'm not going to ask you a lot of chit-chat questions today. So if it's okay with you, we'll just jump right into it, all right?
I appreciate that. Let's get going.
Okay, cool. Just a reminder that today's session is for educational purposes only, and decisions to buy, sell, hold, or traded securities, commodities, or any other investments involve risk and are best made on the advice of a qualified financial professional. And under no circumstances shall we be liable for any loss or damage or you or anyone else incurs as a result of any trading or investment activity that you or anyone else engages in based on the information or material you receive through Barchart.com and our services. So as I mentioned in the opening, why is the head and shoulders pattern so popular is its easy visual recognition. And because it represents this transition between trends. The head and shoulders pattern consists of four components: the left shoulder, the head, the right shoulder, and the neckline. And though there are many variations to this pattern and no two head and shoulders are alike, there is this basic generality, is this symmetry to it. The symmetry to this pattern. And the pattern is not complete until price breaks the neckline. Now, to add, there are a few generalities to head and shoulders patterns, and they include these. The greater the reversal area, or the longer the time period, and the greater the accumulation of distribution of volume during its development, the more certain we are of its outcome. Now, in other words, big reversals, big move to follow. Small reversals, small move to follow. The higher the time frame or primary trend, the greater the implications. And although it's a reversal pattern, price must reverse from somewheres, and meaning that lower time frame reversals may be predictive but shallow in nature, meaning that the head and shoulder appears in a lower time frame and they are opposite of our primary trend, and this could mute price movement. Also, trendless periods prior to development can also lend to a lower amplified response. So let's examine the 4 phases of a head and shoulders top. The left shoulder, and the 2 key points here is that a strong rally on above average volume, and then a drawback on lighter volume. The head, a second rally that extends the price movement, though this rally's volume should increase, but maybe not as strong as the left shoulder. Now, up until this point, the price movement is still showing the characteristics of an uptrend, higher highs and higher lows. The clue of a potential head and shoulders development is this drawback to below the left shoulder and to approximately to the area of the previous recession. So again, let's look at, here's the IWM, right? Here's our left shoulder, that first rally, that pullback on some spike in volume, then another rally, right, where our volume is a little bit less. And at this point, if we looked at this at a chart, this is still showing the characteristics of an uptrend. Higher highs, higher low, higher high, and now price reverses. And if this was a strong uptrend, we would anticipate price to hold the previous shoulder. But the fact that it doesn't, that is the clue that maybe something else is happening. And here we can see price returns to relatively the same area of the previous recession from the left shoulder. Now, the right shoulder is a third rally, but on considerably less volume, and the impulse fails to reach the height of the head. Now, however, this is where the symmetry aspect comes into play. The right shoulder's peak should be relatively similar to the left shoulder's peak. Now, the difference between the 2 peak heights is not as critical as the significant decrease in volume of the left shoulder to the right shoulder. Again, we look at our example here, right? Here we have that rally back to the right shoulder, but notice that if we look at our volume profile from left to right, it is decreasing as we make each one of the different components of our head and shoulders. Now, the neckline is the decline of price down through a line drawn from the bottom of the 2 previous retreats, the left shoulder to the head and the head to the right. And here's where many traders jump the gun after the completion of the right shoulder. What they do is they anticipate this break. But here's the thing. About 20% of head and shoulder formations fail. And the key is for us to wait for the confirmation. And that confirmation comes when price breaks the neckline. Now, just for a guideline or a general rule, a break of 3% of price below the neckline would be a confirmation of your head and shoulders pattern. Now, there are several attributes that we can discuss that can be applied to the breakout. Now, here again, volume is going to take the lead. Low volume activity through the break is a higher probability of we're going to get what is called a pullback or a retest of the neckline. But rarely, though, will we see it go through the neckline. And then usually what we'll see is a sharp reaction from that point. So what I did was I created a watch list for our today's session, and there's a lot of different stocks that I want to show you. Now there's our head and shoulders for our Russell, but let's look at Owens Corning. And I got to go back a little bit in time here. And so we can see that here in the Owens Corning one, right, you get this break of the neckline. And if there is, well, let me put up volume here. Again, I apologize, I didn't have this set up. You know, a light volume through the breakout tends to breed these retests. Now, in the example of Dow, we see an increase of volume from the post neckline, and this increases that probability of a stronger price acceleration and reaction. You can see that here on this example. Now, current market conditions can also influence our pullback probabilities. So if the broader market is trending lower, the chance of a pullback is greatly lower, and there's a higher probability of you're going to see something more like this, an increase or an acceleration of price action. Now, if the broader market is trending up, there's a higher probability that we will get a pullback test and a greater probability of a delay or a tempered downside reaction. So that's the basic components of the head and shoulders top. Let's talk about the head and shoulders bottom. Now, they are opposite for the most parts of a head and shoulders top, but the most notable difference is in the volume profile, especially during the second half of completion. So let's look at those phases and see if we can identify the volume profile differences. Again, the left shoulder is similar to our head and shoulders top, is just opposite price action, a strong decline, typically after an extended move or impulse, an above volume, and followed by a pullback on decreasing or less than average volume. The head, again, a second sell-off that reaches a lower level than the bottom of the left shoulder on an increase of volume. Now, this volume increase should be accompanied with this impulse, but typically is less than the left shoulder. It could be more, but typically it is less. Now, at this point, we're still showing those characteristics of a downtrend, like we talked opposite of our head and shoulders top, a series of lower highs and lower lows. But the recovery above the previous trough low, again, our left shoulder, is a clue something different is about to happen. And the right shoulder is that third decline, which fails to reach the head's low, and typically is in symmetrical position to our left shoulder. Now, volume could be equal to or less than the previous move, but typically increases as price rises towards the neckline. And here's that difference. A rise in volume as price rises towards the neckline, opposite of what we see in a head and shoulders top. Now, the neckline, again, a rise of price through a drawn line from the tops of the two previous highs, left shoulder and the head and the right shoulder. Now, just some generalities here. Don't trust bottoms unless you get that accompanied by that volume increase, especially as price moves through the neckline. Again, the completion of the head and shoulders formation will come after the neckline break. And again, you can use that 3% rule. Now, again, there are some general attributes to bottoms, and bottoms are usually longer in time and flatter or rounder in price variation. Okay, so let's revisit this importance of volume. So in tops, we want to see a declining volume from left to right, and only after the neckline might we see an increase in volume. Now, bottoms, we want to see a spike in volume on the left shoulder and typically equal or less to the head, and then an increase from the head through the neckline break. Now, the increase in volume on a neckline break increases the post-break performance. Now, low post neckline break volume in both cases typically produces those retestings of the neckline and can dampen the minimum price objective. We'll look at that in a moment. So this is just some basic rules or ideas behind the concept of a head and shoulders. So let's move to some real market examples and see if we can also explore the benefits of identifying a head and shoulders, and that's something called the measuring aspect or the price targeting for our head and shoulders. Okay, so let's go back to my watch list, and again, I've blown this out onto my flip charts. And so again, you can see here on the IWM is that development of our four phases, that left, the head, the right, and that consistency of the neckline. Now, there are some variations in terms of necklines, horizontal necklines or rising necklines or falling necklines. Typically, you'll see more horizontals, and then you might see some rising necklines in tops. And a more rare would be a falling neckline in the top. Now, there are some differences how you can measure the movements of breakouts. Typically, if you have a falling neckline, that would decrease the result because the market is already moving in that direction. So then we see our ensuing break through our neckline and the follow through of price action. Now take notice that the volume profile here, right? Our volume profile throughout our process is decreasing. That is key to a good head and shoulders formation as price is transitioning from one trend to another. Notice that we do see a blip up in volume as we're breaking through our neckline. Now, the break through the neckline, one of the traits of a head and shoulders is this measuring capability. And the distance of the head to the neckline can be used to measure a ruler, a measuring stick of the distance when price breaks through the neckline. Now, this will help us predetermine a price objective. Now, in the case of the IWM here, there might be two factors that might be coming into play. First, the broader market rallied, and that might dampen or delay our price objective. And the fact that the entry of this head and shoulders came from a shallow sideways market rally, right? So let's look at that. So we say that a head and shoulder is a good reversal pattern, but we want to reverse from something. And in this case, you can see we're reversing from basically a sideways action. So that again could dampen our result. But what we do see here is that price did reach the low of the origin of this leg up. And so what we'll discover is that the minimum price objective in a head and shoulders value will be the lesser of two, the origin of the move in this case, or the distance between the head and the neckline as we break through the neckline. And here in the example of Owens Corning, we have a more classic head and shoulders. A higher left shoulder, our two impulse rallies accompanied by an increase in volume. A third rally that is lower in height and lower in volume. And the post neckline breakout volume increases, right? Low volume as we break through our neckline increases that probability of a retest. Again, measuring our head to our neckline, in this case, could give us a potential target of how far we think. Again, the lesser of the two, either the distance from head to neckline or the origin of our last impulse move on the uptrend. So here, this case, it was the distance in the head to the neckline. Now, I'm a bit conservative when I draw this formation. So what I'll do is, you can use the height, the highest price, but I tend to be a little bit more conservative. I'll use the close of the candle that makes my peak. And that's what I did here. So you can kind of see that. Again, this is just a bit of being a little bit more conservative when we draw this measurement. Here's the Dow, which is just the opposite of what we saw, right? We see the proper volume profile, right? A declining volume from left to right, but notice the distinctive increase in rapid downward acceleration post-break that comes on a distinctive rally in volume. Again, I could use my candle to my head to neckline candle distance or bar distance to extrapolate or determine a minimum price movement. But notice in this one, the strength of the acceleration did move us back to the origin of the impulse that started the first leg into our head and shoulders. Again, the general rule here is the minimum price objective is the lesser of the two. In this case, this one overachieved. So I want to talk about some variations. We're going to look at a couple of different variations, and sometimes you might get multiple shoulders. Again, a key here is to make sure that we see that proper volume profile, a decreasing from left to right. But when we look at multiple shoulders, what we want to see is that transition from an uptrend to a downtrend. And so we think about it that an uptrend is a series of higher highs and higher lows. That's kind of what we're seeing here. And a downtrend is a series of lower highs and lower lows. And you can notice that our two shoulders here on the left side, we see them are inclining, and here they are declining. Again, notice light volume post breakout breeds that retest of the neckline. Okay, so those are some examples of tops. Let's look at some examples of bottoms. So here on Procter & Gamble, again, you can see that spike in volume on the left and that slight increase in volume as we make the head. Notice the light volume as we retest or as we break through the neckline. And what did I say to you? On bottoms, you want to, distrust, I think is a better word, those bottom breakouts that don't have an acceleration or an increase in volume from the head to the right shoulder and then through the breakout. But in this one, I think you can, again, that would breed a retest. But in this one, what we do see is post retest is we see multiple gaps, and gaps are a sign of strength. So that is really what overcame and let this particular stock rally up. Here's Costco. Let me drop down. So I've been giving you a lot of examples in daily time frames, and you can find them in weekly as well. Again, I want to find these in higher time frames. You're going to have a lot more predictability, and again, for trading purposes, you're going to get some greater risk reward ratios. But here I'm going down to Costco, and I'm dropping down to a 60-minute time frame. And what I want to kind of point out on this one is, especially those of you who are going to start trading, looking for these head and shoulders in what I would call micro time frames or minute time frames, is now this is a stock. Again, notice that we have our spikes. There's our spike coming into our shoulder. There's our spike near our head, right? Again, a little bit of a spike in volume post head, and then that spike in volume as we break through the neckline. So how many of you have heard the expression that professionals close the market and novices open the market? Notice that the two spike volumes come at 3 p.m., especially this one here on the breakout. That is the end of the day. That's when professionals are marking the market, or marking the books, or taking positions. And notice the head, right? The head, again, a little bit of a spike in volume, so we want to see. The head was created early in the morning session when novices are making a mistake. So this is, again, another way to kind of enhance your head and shoulders is if I see the formations of my components are being created in the proper time frames. And those time frames that would be more important to me would be those mornings and morning openings and afternoon closes. Now, head and shoulders are not limited to equities only, although I'm going to show you here an example in a stock index futures contract. Now, the difference in futures and Forex in terms of head and shoulders is that we have a longer trading day. But what I want to show you here, again, which is kind of building on what we just talked about with the Costco example, is I want to make sure that my components of my head and shoulders are created and accompanied with volume. And that volume is being created during what we would call the active hours, or sometimes referred to as the regular trading hours. Again, the NASDAQ futures contract trades about 23 hours a day. But we're looking at our left and right shoulders were being created in those early morning sessions or in the late afternoon when we're making the close of our market. So that is important to me. I want to make sure that my components are being created in regular trading hours. So here's the sugar market. And again, right, we see typically in bottoming markets, a little bit less price variation and a much more flatter market. Though we do see that increase in volume on our shoulder, our head, and as we accelerate through our neckline. But again, a lot of times on these type of flatter breakouts, we don't get that big fall through or that volatile fall through. And again, notice that we do get a little bit of a retest of our neckline. Again, an opportunity. If you see in head and shoulders and you're waiting for the confirmation, there still might be an opportunity for you to get into this trade. on that retest of the neckline. And again, notice that the low volume post breakout dampens that price action afterwards. But we did get, if you can see here, we did get our target. And again, let's just kind of do that real quick for you. There's our neckline to our head. And then here's our neckline break. And you can see that that was our minimum price objective, and we reached that very easily. Okay, silver. Here's that example of a wider price action and a little bit more volatile price action. Again, here's, a little variation as well too, rising head and shoulders. But again, if we think about this, right, this transition from downtrend to uptrend, this would be more in line with what we would see with a bottoming action. But that violent move and that wider range does result in that greater volatile follow through on the breakout. And again, notice that you do see that greater volume as we break through, and then that volume follow through as we reach our minimum price target. Here's soybean oil. Now, this is another variation to head and shoulders, and this one is our two-headed head and shoulders. Now, these are more rare, right? And you could maybe make an argument that this is not really a true head and shoulders, more like a double top. But notice the symmetry of the two shoulders about around the two heads. And again, notice the light volume on the breakout. Again, that breeds, there's our breakout, the light volume that was in the overnight hours for soybean oil, right? Not during the regular trading hours. That would breed a potential retest of our neckline. And that retest came in the beginning of our opening hours of our regular trading session. Again, if you think about this in terms of sentiment and market conditions, right? This is where our bulls are trying to recover the market and they're unsuccessful. And this is kind of the last gap's chance of trying to save this uptrend. And this is where they start exiting the market, where maybe you might find sell stops, as the market falls back below these lows. But let's talk about post pattern completion rules and why head and shoulders, even though if I don't get an opportunity to catch this trade as the head and shoulders being created, I can use it as an area of supply or demand or support and resistance based on the components inside of my head and shoulders. So necklines and right shoulders act as levels of support and resistance. Now, in this case, this is a resistance, right? Because we are at a topping head and shoulders. So notice that after our completion, after we got our minimum price objective, and in this case, it was both the distance from our head to our neckline, and if you measured that out, that would be around about here, but our spike low is back to the impulse of origin of our move. But notice that on the return, as price returns or recovers, that this high falls in line with our previous neckline. And then later, when price recovers, again, our spike high on this leg up is in line with our right shoulder. You can use the necklines and shoulders post completion as possible levels of support and resistance. Nutrient, and this is another variation to head and shoulders. And let's go back here. Here we go. Again, this is our multiple head and shoulders, multiple shoulders. And again, what's the importance on these multiple shoulders patterns? Again, that incline on the left side, right? Higher highs, higher lows, right? As the market is still trending higher. And then the decline on the right side, right? Lower highs and lower lows. And this is really kind of gives us that sense of that transition from an uptrend to a downtrend. And that's why head and shoulders are these powerful reversal patterns. And also because why it's very easy for an untrained eye to see them, because it's basically kind of this rounding pattern, or this, trough to peak and peak to trough a pattern. Notice again on this one, as we walk through this, notice again, what was crucial to this pattern was that proper volume profile. And again, post-pro neckline break, we got that spike in volume, which then drove our price down. But again, one of the things I said to you can do is, you do that measurement, or that our minimum price objective could be the origin of our last impulse, which it looks like that's exactly what happened. So then the pattern has been completed, the head and shoulders pattern has been completed. And then on the preceding rally, now notice this, whoops, my little purple line got a little out of whack. Notice that our left shoulder, right, we make a head and shoulders pattern, right, later in time, that our left shoulder is in line with our previous neckline. And our head, in our head and shoulders pattern, is in line with our previous right shoulder. So again, using these former levels or components of our original head and shoulders is now an area where we can enter or re-enter into this market based on this concept of support and resistance, in this case, in resistance. That brings me to meta. Now, meta here is going to be something a little bit different for you. So let me just change this time frame. So I want to go from monthly 60 minutes. I'm going to go to, first, let's start out in a daily chart. This is a three-month daily chart. So this variation is about what we call the fractal nature of markets. In other words, patterns inside of patterns. Now, you might encounter this scenario that the head, or in this case, the right shoulder, is a mini head and shoulders pattern. And again, this just adds to the confidence of the larger time frame pattern, right? But more importantly, what we're going to discover here in a moment is that the head and shoulders in the micro time frame, the minute time frame, right? What we want to do is we want to take that time and take a step back and look at a higher time frame to see if there's something greater going on. Is the lower time frame with our trend, or is it against our primary trend? So let's walk through this. So you can see a little bit of a head and shoulders pattern here at the daily time frame, right? There's our left shoulder, there's our head, there's our right shoulder, and a classic, right? In our classic, the left shoulder is higher than the right shoulder, and again we see that proper volume profile, and then that little bit of spike volume as we break through the neckline. So this is daily. So let's drop down to a 30-minute chart. And again, what we see here is inside of our right shoulder, there's our right shoulder, is a little head and shoulders. And this is a fractal nature of markets. You will see this a lot inside of some of these head and shoulders, especially at the heads and the right shoulders. So again, in terms of trading opportunities or risk reward, setting a risk, we can use the right shoulder as an area of risk. Maybe we use the neckline as an entry, but here you can see price came back, tested the right shoulder, and then eventually price did reach our minimum price target. Again, that would have been either the distance of our neckline to our head, or price returning to the origin of the last impulse. Again, another thing we talked about was a head and shoulders pattern needs to reverse from some type of price action. And you can see again what we saw similar to maybe the IWM is, yeah, we did see a bit of a rally here, but this is a very shallow rally, right? So the minimum price action was delayed or muted. It took a while for this because we're not really seeing a major reversal here. And again, at this point, what I might do is take a step back and say, okay, is this a head and shoulders that I want to trade? Did it get to that price objective? Yes, it did. But that head and shoulders pattern is in opposite of our primary trend. So in this case, maybe this would have been a better example, maybe better for somebody who wanted to maybe do a short-term trade, maybe a day trade or a swing trade. But for a longer-term investor or a longer-term trader, this head and shoulder pattern would be one that we would discount or probably even throw away because it is not an extreme movement and it's shallow rally coming into it, but also the pattern is opposite of our primary trend. Okay. All right, Gene, let me do this. I'm going to read a couple of questions here that I see. And I see Henning asks about the S&P having head and shoulders formation. And he's asking, is the price running back to the area of the formation? Will price now go back to the downtrend? So let's do that. We'll go and we'll look at S&P. And I'm going to just put up the index on this one. A lot of times, though, in the index, if I'm going to do an analysis in terms of indexes versus, let's say, the ETFs, I might be more inclined. Now, this is, you're kind of getting into my little weird world here. But yeah, I think you can make an argument that this is a bit of a head and shoulders. Now, what would be the key for us, right? The key for us would probably be, let's look at that volume profile. And again, if I'm doing the indexes, I can't do that. That's why we need to go to an ETF. So that's why I basically do that. So let's go to our template and look at our volume.
Hey,
And
John, just a
yes,
suggestion. If you want to have a clean S&P chart, go to My Charts. That way it won't show all your drawings. Just start a new chart in My Charts.
I gotcha.
No, don't add it. Go to your Tools menu, My Charts. Right, and then add a new chart. No, plus new chart. Yeah, there you go.
Thanks, Gene. I always learn something in these sessions.
Got to put a description. Just put in something. XXX, yeah. And you might want to start by clearing the chart.
Yeah.
Okay, there you go.
So I think what the person is asking, I think Henny is asking, is this a potential head and shoulders? Now, again, this one would be a different variation, right? What did we see? First of all, our right shoulder is extremely higher than our left shoulder. There's not a lot of symmetry here. Now, it does look like we broke through what would be a level of support, and then we are coming back and retesting it. That would just be regular charting analysis. But again, what I wanted to say is let's look at the volume. And I think what we're going to discover here is, in this case, we're not really seeing that proper volume, right? We're not really seeing that, right? We do see a little volume spike on the left side, but notice how we're seeing a volume spike on the right side as well. So that would tend to me say that this is probably not a really good example of head and shoulder. I think what you might be seeing and what I see here is this is just a retest of a level of recent support. Okay. So I think David is asking basically the same question, right, about the S&P or the SPY. And then Zach asked something, would you buy puts at the end of a right shoulder? Again, Zach, this is where a lot of traders jump the gun. They buy the puts and then the market does not break through the neckline or does not confirm, right? Or, because it took a long time for that head and shoulders formation to be created, it might take a long time for it to reach that minimum price objective. So, what puts are you going to buy? You're going to buy short-term put. Well, it's going to expire worthless by the time the market reaches that price objective. So again, I would probably wait for that confirmation and then extrapolate, let's say, the time it took to complete the head to the right shoulder, how many days or weeks or months, then I would correlate that to the right options to make sure I have enough time for me to get that minimum price objective. Okay. All right. So let's do this. If I didn't answer all your questions, I apologize. Again, you can send your questions to support@barchart.com, and we have a great staff. They'll answer all those questions. And if you want to address them to me, they will pass them along to me. Okay, so what are some of our takeaways? Remember, the head and shoulders reversal pattern is a dynamic chart pattern that identifies this transition between reversing trends and or price action. And if we're finding these head and shoulder patterns in, let's say, lower time frames, we got to take them with a certain grain of salt, right? We want to make sure that if we're going to take a trade with them, we want to make sure that the pattern that we're seeing, that breakout from the neckline, is going to be with our higher time frame trends or with our primary trends, not against them. Doesn't mean that the market can't make that minimum price objective. It's just that we probably want to look for those ones that are with our higher time frame price action. Now, it can be found in all time frames, as I just mentioned, though it's more reliable and more significant and prominent in extended periods. Again, our higher time frames, our dailies, our weeklies over a longer period of times. Again, the ease of recognition, and I think this goes to Zach's idea, among impatient analysts, it causes them to anticipate the formation and to act prematurely. Again, the key to a successful head and shoulder reversal pattern is the completion of that pattern. In other words, we want to make sure that we see that correct volume profile and that neckline break confirmation. All right, I know this was kind of a basic session today, but I thought that we needed to talk about this. And I hear the term head and shoulders a lot. Because the human eye wants to try to make sense of randomness. And so what I really did today was I really broke down this for you so that you can follow these simple rules, these 4 phases, and then rely on that idea of volume to help you determine, is this a head and shoulders pattern that you think is worthy of investment or trading based on that pattern and that volume action. Okay, so I want to remind folks that if you're not familiar with Barchart or Barchart Plus and Premier, we do offer a 30-day trial subscription, and that's going to give you to a lot of advanced features. I didn't really show a lot of advanced features today, but in terms of screenings and other trading ideas, investment ideas, which you can use. So I would recommend that if you haven't done that yet, take us for a spin for 30 days. What's it going to cost you? It's a low risk trade, right? Zero risk and maybe a potential large reward. Okay, and so next week, I think I'm off next week. I'm doing a special webinar off of Barchart site. But in 2 weeks, we're going to do my 3 favorite indicators. And we're going to look at what I like to do. So I want to pick 3 indicators. One that's going to give me more of an idea of probability, one I'm going to use for momentum, and one that I'm going to use for confirmation. So that'll be in 2 weeks' time. What am I forgetting, Gene? I don't know. I didn't mean to ask you. I'm just thinking out loud here. I think that's about it, right?
That's just about it, other than to remind people who are Plus and Premier users to join you for your market on close session. Although there is not one this week, I'm so sorry.
Yeah.
Got to wait a couple weeks for that one.
You have to wait for a couple of weeks. Again, Premier and Plus, folks, this is an opportunity to get a little bit more intimate. When we look at a lot of trading ideas, we kind of try to make the connect the dots between macro market events and some trading opportunities using some of the tools and ideas that are on the website. So check that one out if you're a Plus or a Premier. Well, Gene, until next time, let's wish our folks out there the best of health, be safe, and the good of all trading.